So welcome to our quarterly webinar. As those who have joined us previously will know, what we're hoping to do today is to share some food for thought, hopefully a couple of pointers and maybe some takeaways that allow all of our clients and businesses that we're talking to in the retail and consumer sector to have a little bit of an insight, perhaps some helpful tips as they go through what we completely understand to be a continuing challenging moment for our sector right now. So with that, I'm delighted to pass over to my colleague Sophie, who's going to take us through our high street sales tracker and give us an insight into real time what's happening right now in the sector.
Thanks, Laura. So good morning, everyone, and welcome. Our high street sales tracker, just a short reminder, it tracks like-for-like sales across discretionary spend. That's fashion, lifestyle, and homeware. And I think the shape of this slide actually says it all, because at the start of this year, there was lots of media coverage and lots of noise about the growth that we were seeing throughout last year, and indeed we continued to see in the early part of this year in terms of consumer spending. And that noise was that actually the inflationary pressures and the cost of living crisis was really only going to begin to be felt post-April. And this is what that slide shows, in that as we entered into April, the high levels of inflation, the deepening cost of living crisis, and now what we're in terms of historically low levels of consumer confidence, we have seen that growth slowing. Some might say, well, it is still positive, and actually pre-pandemic, a positive like-for-like of less than 5% was a good place to be. But we've got to remember that we are comparing against far weaker benchmarks. And what we can clearly see is that the growth in that discretionary spend has substantially slowed. That blue line, which is the non-store line, in the first few months of this year, it was negative. And that is compared to when the country was in lockdown last year. But also, we've got to remember that actually we had rates of 100% plus throughout the pandemic. So again, we're seeing the non-store like-for-likes now really flat. Next slide, please. When we turn to this by channel, next slide, sorry. When we turn to this by channel, what you can see is that the homeware sector was the first to show that those signs of increased consumer caution. And recent months has clearly shown that purchases, those bigger ticket items, are being deferred by consumers. I guess with the cost of living crisis, this would be as expected. But since spring, we've also seen the other subsectors of lifestyle and fashion also beginning to slow. Fashion actually has remained relatively strong, and it was strong in the second half of last month. And perhaps that's people updating their wardrobes with this fabulous weather and in anticipation of holidays. But we are expecting that to slow as well. Next slide, please. Finally, what you can see is that the average footfall against the like-for-likes has also slowed. So it's fallen in the past few months. And again, that's perhaps comparing it to when things began to open up and last year, so footfall was higher. I think, though, in summary, these results do confirm that there is a real concern for retail. Consumer confidence is at historical low levels, and we know that consumer confidence drives discretionary spend. Real wages are at a 20-year low, and interest rates are set to rise. So I wish I could give better news, but there are certainly few signs of encouragement. All of these are indicators that there is a tightening of the consumer purse on discretionary spend. And as I said earlier, as expected in those bigger ticket items with homewares feeling the biggest drops. We hear, though, that retailers have accumulated stock levels, and therefore they are faced with a real challenge. With their own cost base rising, it's difficult to see how they can discount that stock too early, but they've got to balance that against unsold product. So what's going to be really, really key is that effective stock management and working capital through the next few periods. And I guess, just to conclude, it's retailers will be looking to the government, whoever that may be in place, but they'll be looking to them for the levers that they do have at their disposal to get inflation under control and ease that cost of living for the consumers, creating an environment where retail can begin to flourish. I haven't had many positives there, and I hope you hear some positives from the rest of the team, but I'm going to pass back to Laura, and I'm unfortunately dropping off, but I hope you enjoy the rest of the session.
Thanks, Sophie. So a stark awakening for this morning's session in terms of what I'm sure some of you are already feeling as we go into the summer season and when you're seeing trading come through. And certainly I know from the conversations I'm having, it's very unpredictable. And I think unpredictability continues to be one of the biggest challenges that the sector faces. With that, one of the things that we feel is really important is to make sure, therefore, that you are prepared, you understand the landscape that you are approaching. And so with that, I'm going to pass over to Neil and Matthew to take you through, which we know is one of the issues that, again, people talk to us regularly about on, Brexit certainly doesn't feel like a distant past, and it's very much here in the future. So with that, I pass to Neil to take over from here.
Lovely. Thank you, Laura. Good morning, everybody, and welcome, Matthew. So could I have the next slide, please? Oh, thank you. So Matthew, customs and international trade has not been far from the front pages over the last couple of years. It's definitely a hot topic for the sector. But before we get into specific current market issues, maybe you could give us a quick canter through the basic mechanics of customs duty.
Yeah, thanks, Neil. That would be great. I think you're right. It's been an ever-changing landscape, hasn't it, for the last couple of years for international trade in the UK. One would think that it would have settled down post-Brexit by this point, but we've still got issues, especially around Northern Ireland. And I know that's a hot topic, and we're helping an awful lot of businesses reclaim track duty for goods that are staying there. But just talking about the basics of customs duty, because remembering there was an awful lot of businesses that only traded within the EU. They weren't used to importing and exporting. It wasn't something that was familiar to them. So just quickly running through those basic mechanics. There's 3 different customs duty tenets or factors that come together to determine the customs duty that's payable on goods that you import into the UK. So the first one is the value of the goods that you bring in. So the customs value is based on the cost of the goods and the insurance and freight to the UK border. But a little known change that came in a fair few years ago now was it's on the last sale for export before the goods move into the country. And that can sometimes catch people out, especially if there's a chain of transactions of sales before the goods come in. When does title pass? Is it passed before the goods land at the customs border or after? How do you structure those contracts? Because actually structuring those contracts can make a big difference. If you increase the value, of course, you increase the customs duty payable. So that's something that people need to be cognizant of. Yeah. The other aspect is origin. The UK is now boldly going out into the world and entering into its own free trade agreements, which is great. It means that we can pass goods back and forth between countries free of customs duty, but you need to meet rules of origin to avail yourself of those preferential duty rates. And origin is basically where the good is grown, where it's mined, where it's farmed, or where it's last manufactured. So on a simple basic, think of those things. And one thing that we have seen in terms of Brexit that's been quite difficult for importers to get their head around is origin does not always equate to the place where the goods were shipped from or where they were supplied from. So an awful lot of businesses have been caught out by saying that we believe the goods are European origin because, for example, they're being shipped from Rotterdam, but in fact they're made in China or the Far East, which does not make them European origin. And we are seeing quite a lot of businesses being caught out by that by HMRC. And then the last factor is classification. So for people that are really into the nitty-gritty of customs, you'll know it's a 10-digit numerical code that determines the customs duty rate. Easy to get wrong, especially in retail. That can be in terms of a t-shirt, sounds fairly easy. A t-shirt's a t-shirt, but then you have to look at, well, what it's made from. You know, what's the cotton content? What are the other materials that are in it? And how does that affect the classification? So that's something that is quite easy to get wrong, and it's a really easy thing for HMRC to come out and audit the classification of imported goods, and there's lots of businesses that don't always keep on top of that. So I think as a whole, they're the basic mechanics, just to kind of bring it together at the start of our conversation to say they're the three factors you need to be most cognizant of.
And Matthew, just before we move off that, do you want to just maybe touch on the transfer pricing value and the impact of royalties and license fees in the price for customs duty?
Absolutely. I mean, I think of the three, which is the area where we think, you know, you're getting most challenge from HMRC, or the area's bit to get wrong, and it's definitely the valuation. And one aspect of that is, as you mentioned, the interplay with transfer pricing, where you're buying or selling to a related party. And of course, when we were in the EU, buying and selling from a related party did not affect those transactions from a customs perspective, because the goods simply weren't passing an international border. Post-Brexit, the border went around the UK, and now you've got to look at, okay, I am buying and selling to group entities. How does my transfer pricing policy affect my customs duty? Do I have royalties? Do I have license fees? Do I have sole distribution rights? Because they may need to be added to the customs value, and that can push up the price quite considerably. And one of the other things that we often see is a post-importation transfer pricing adjustment, Neil. So, you know, we haven't quite met the margin that we wanted to meet. We've got to do a true up at the end of the year, or maybe several times during the year. You know, if that affects the goods, then we have to go back to HMRC and say, okay, we have changed the value of those goods and we need to declare to you. And that could go up or down, Neil. So it could be a reclaim position just as easy as it could be an extra payment position to HMRC.
Yeah, and that's, in my experience, that's definitely one of the key points that catches businesses out. They make those transfer pricing adjustments and then forget about the customs duty impact, and then 2 years down the line you've got a nasty inquiry to navigate through. So just moving sort of towards the top bullet points, it's now 2 years since Brexit actually came into effect. And what's your take on supply chains? Are they back to normal now?
Well, I think it's still, you know, a changing environment. We listened to Sophie before, didn't we, on kind of how it's going for retail and the high street at the moment. Certainly from our perspective, I know we've spoken about kind of the cost of freight in containers that was just astronomical last year, wasn't it? It got so high. You know, sometimes I was hearing 14,000 per container, which is just incredible when I've seen it under 2,000 previously. It's such a big shift. And with cost of living, there is an awful lot of procurement activity now looking at alternative sourcing. Can I get it either somewhere closer to home, so I reduce my freight costs and I purchase it closer to home, perhaps using a free trade agreement from Europe, or, you know, can I look further afield and I'll use a cheaper manufacturing cost, but I'll also look at a free trade agreement with countries just to see if I could take away the customs duty completely. So there's that to think about. But I think with Brexit, one of the main things that I've seen is companies just did well to keep their supply chains moving. Simply being able to say, I can get my goods where I want them on time was a massive plus for companies during that post-Brexit period. And I think now what we're seeing clients do is starting to turn to, okay, we've kept our goods moving, but are we quite as optimized as we should be in terms of what's the procurement structure, how's our supply chain optimization, from a duty perspective, am I doing the right things to lower that cost? I mean, I always associate retail with clothing. I do that an awful lot. I know that's not everything that is classed under retail, you have to forgive me. But the duty rates on clothing are kind of, 10 to 14%, high rates. If you're doing something wrong and you're overinflating your price, or you're classifying it and it could be a lower duty rate, it's really important to get that right. And I think some of the things that companies have struggled with is the multiple models of supply and sale that you have in retail. So I dealt with some really big global brands last year, and we ended up with very different valuation and clearance models for the business to business sales. They had their business to resale into the shops. They had their business direct to consumer across the channel. And then, they were doing the online marketplaces through another online marketplace, not through their own website. And they actually had to have 4 different sets of policies for all those different ways of getting their goods ultimately into the market. And I think that the border itself has thrown up some really tricky issues to look at in terms of, I know we've spoken about returns, haven't we? You pay the duty in the UK, but then you ship it over into Europe or vice versa, or you restock back into a distribution center that is across the channel again. What do you do about that? We're seeing a massive increase in companies applying for customs warehousing so they can hold stock. If they want to release it into their home market, they pay the duty in the UK, sell it to a UK customer. But if it's held in a customs warehouse, you need to get it into the EU. You never pay the UK duties, then you send it into the EU, you only pay the cost once. And track duty on returns and things like that is something that's quite difficult, but we are helping clients actually get through the complexities of that and put models in place to enable it.
And that track duty is certainly a very prevalent issue in the sort of e-tail end of the spectrum, isn't it, where returns are significantly higher. And it can turn out to be a massive cost if things are stuck in the warehouse and it's uneconomical to move them on. And I think, as we've talked about previously, there's a big change coming up, isn't there, from 1st of October? Do you want to just touch on that?
Yeah, so I've affectionately used Chief, which is the import declaration system to lodge your customs declarations to HMRC. And that's been in place since I started doing customs duty, so well over 25 years ago. But the system that it's being replaced with, CDS, on the 1st of October for imports and then the 1st of April for exports next year, it's akin to HMRC moving from a Commodore 64 with a black screen and a green moving cursor to an iPad that enables you to do data analytics on the spot. It's such a stark difference between these two systems that they use. So that's going to enable HMRC to capture more data and do more analytics and make their audits more informed in terms of what they go out and ask the questions on when they visit a trader. But I think one of the main things is on the 1st of October, a UK importer has to have gone into the government gateway to authorise their new CDS account, activate their new CDS account. You've got to get your customs broker's EORI details and actually put them in there and authorise them and decide how you're going to pay. Is that going to be cash? Is it going to be deferment? Now, all those steps you have to do yourself through the government gateway and the CDS portal. You can't kind of outsource that or pass it on to your 3PL or customs brokers. So there's some hard actions there that businesses need to take. HMRC sent out an alert that, clients may have received that by letter or email to say, you have to do this yourselves by the 1st of October. And if they don't, Neil, simply put, their goods will stop at the border until they do it. So it's something that everyone that imports has to do this well in advance of the 1st of October, I would recommend. And of course, if anyone needs some help with that, they can always get in touch with me or the team at BDO.
Yeah. Lovely. And that last point on the slide, I think is worth reiterating, isn't it? That customs duty and all the stuff around Incoterms, who's the importer, who's exporter, etc., is complicated enough. But actually, when you've got goods on the ground and perhaps people on the ground supporting those supply chains, there's lots of other issues that need to be taken into account, whether it's VAT for onward supply in a particular jurisdiction and making sure you're appropriately registered, dealing with employment tax if you've got people on the ground, and if you've got significant infrastructure, then are you creating a taxable presence for direct tax in that location as well? So a multifaceted, complex environment that retailers need to navigate through when they haven't got enough on their plate already. So Matthew, one final question then. So just as we close, what sort of key point would you leave our audience with to address going forward?
I think what I'd say, Neil, is especially with the cost of living increase and inflation and all the costs that businesses are facing, I really do think now's the time to review the supply chains and what they're doing to check that it is as optimal as possible. You know, just make it lean, you know, strip out any extra cost. And from a customs duty perspective, especially in retail, that can be quite a high cost in terms of your cost of goods when you land them. So just reviewing that, optimizing it, make sure you're paying the right amount of tax, but as low as you can, is absolutely imperative to just do well in this environment, I think.
Perfect, very clear. Thank you very much, Matthew. And I think I'm handing back to Laura.
Thanks, Neil. So again, hopefully some useful tips. And I should have said at the start, if there are any questions, just post it in the Q&A function. And we do have a session at the end of the webinar to pick up any questions from the audience. So moving on to our next session, where I'm delighted to be joined by Rory Gibbs, who is part of Piper Private Equity and has agreed to join us this morning to hopefully take on the challenge that Sophie set Rory and I to be slightly more optimistic about the landscape into which we face. I'm going to let Rory give us a quick insight in terms of Piper and tell us why I've invited him today and their lens on the sector. So Rory, the floor is yours to tell everyone who you are and a little bit about Piper.
Morning, everyone. So I'm Rory Gibbs, an investment director at Piper. So I'll tell you a little about what I do and a little bit about Piper. So my job at Piper is to find new opportunities. It's to evaluate businesses, it's to execute transactions, and then to sit on boards to kind of really maximize their value at exit. And I've led our investments into Omelette, the pet products business, Barking Heads, our premium pet food brand, Mindful Chef, the healthy recipe business, Bloom and Wild, the flower delivery brand, and Bruce's, our dog daycare centre. So a variety of consumer brands across different channels, the last two that I currently sit on the board of. So just to give you a little bit of flavour of Piper. So we're a growth investor in challenger consumer brands. So we're investing between 5 and 20 of equity. And we're typically partnering with these brands, often taking a minority stake and helping grow them to sell to trade at the end of the day. So we raised our 7th fund at the back end of last year, which is just over £100 million. And we've made one investment in that fund to date. But we invest across the consumer space. So at the moment, we have 13 investments, and they're across a variety of sectors. So in pet, kind of socializing, travel, health and fitness, home and lifestyle accessories, beauty, and food and drink. But what we look for is, well, what's going on in the macro trends within consumer? And from our perspective, there are 4 kind of main drivers. The first is around health and wellness. Second, indulgence. Thirdly, digitalization, and fourthly, sustainability. So it's really kind of deep diving into the kind of segments that I mentioned and looking across those macro trends. So in terms of kind of Piper, so how do we differentiate? So there are 4 main areas that we can help businesses. The first is around their growth strategy. So it's not about just growing a big business, it's about growing a valuable one and working with the team there. And then the other 3 areas are around brand and proposition, digitalization, and team and culture. And we have an in-house team here at Piper who are not financiers like myself, but are experts within their own fields who kind of help our partner brands grow. So that hopefully gives you a very quick intro into myself and Piper.
Thanks, Rory. And so we started our session this morning with Sophie, and clearly some insight to the cost of living crisis, perhaps starting to slow down some of the performance of retail and consumer facing businesses as we go into the second half of 2022. Now, as you say, you've got 30 portfolio businesses that very much live and breathe in this sector. So what's your insight in terms of what are you seeing at the coalface of this sector right now?
Yeah, so sorry, Laura, 13 at the moment.
Oh,
Maybe it's unlucky for some, I don't know. But obviously that's our current number. But we're typically investing in premium brands that have been able to articulate how they're better and different and are in growing markets or subsets of growing markets. So they should hopefully have a following wind and shouldn't be the worst hit. But I guess what we're seeing at the moment is a little bit of a polarization between products and services. So for products businesses that did really well during COVID, particularly the online guys, they're finding it a little bit tougher now, with consumers switching their spending to services, which makes sense as people weren't able to spend as much on services. So our travel businesses, got two in the travel space, are doing very well, as are our restaurants. They're absolutely flying as people are still kind of keen to go out and meet with people. And our dog daycare brand Bruce's is also doing very well, but that might have been helped by everyone buying a dog during COVID. So that's what we're seeing a little bit there. But within products, I think performance is mixed. So some are doing very well, and if I think about the kind of key themes, so I think those that are doing better definitely have a multi-channel kind of model. So they have their online part, but they might also have stores. They might also have kind of key wholesale accounts as well, so customers can still discover them. And also they'll have an international element to them as well. So although inflation and the kind of dampening of consumer is a worldwide issue, it seems to be affecting different countries at different rates. So our businesses that sell into the US, demand seems to be very strong there still. Also, it's slightly stronger in mainland Europe than it is here. And I think one of the key themes of businesses selling online is that obviously inflation is an issue, but it's also an issue on recruiting customers. So it's becoming much more expensive to recruit customers. I think Facebook and Google are the real winners here. So it's trying to kind of diversify that recruitment into other channels, maybe taking people offline to then buy online. And we're working with a number of our brands, really just trying to work out, well, what is the right rate of growth at the moment. So you don't want to blow out your business model by trying to hit your kind of customer numbers, but actually we're in a little bit of a kind of strange time. So yeah, I think all companies we work with are seeing the cost of goods rising, and you've got to be able to pass at least some of that on to your customer. And I think the important thing at the moment is really being able to demonstrate how you're better and different, and why a consumer should buy from you, kind of compared to your competitors. And if you're able to get your comms right, then you should be able to support those price rises. I think.
Rory,
yeah, sorry.
Sorry, Neil and Matthew talking about that internationalization piece. You know, in your experience in the businesses that you're talking, because we talked about your portfolio, but as you said, you focus on consumer businesses, so you must be talking to many businesses every day. Those supply chain issues, those headwinds that we've faced as a sector over the last 2 years, effectively. Are we still seeing those? Are there sleepless moments with the businesses that you're talking about? And are there anything that you're seeing where people are seeing those green shoots in just having that internationalized business, both from importing and exporting?
Yeah, I think most people selling into Europe kind of set up distribution hubs if they needed to. So I think that seems to be working more efficiently now. I think the shipping costs that we kind of talked about earlier, that they are beginning to come down a little bit, but not quite as much as people would maybe have hoped. So yeah, I think I think it's fine. I think that the big unknowns are if kind of certain areas, particularly China, get shut down because of their kind of zero kind of COVID policy still. But no, I think on the whole, kind of supply chains seem to be running a little bit smoother. I think the issues now are more around people than moving products, particularly in the UK, particularly in the service industries, restaurants, travel, etc. In industries that were kind of partially closed for a long time and impacted by a lack of people coming across from Europe from Brexit. I think that people seem to be more of an issue rather than getting goods across.
No, really helpful. And again, picking up that point that you mentioned on gaining that customer's attention, are you seeing anything where there are some real winners that are doing something quite innovative in trying to gain customers' attention? So we talked about multi-channel, and I think we would all agree that I remember sitting in January 20 and saying that there had been a move to online, there would be probably a rebalance back, and then we had COVID, so everybody went online. But it feels very much that rebalance of the right focus of where businesses retail is quite important as people think about longer term, because I think it's very easy to think short term right now. With where we are with the pressures, people become quite inwardly focused, and I think they need a plan that is both short term and medium term to make sure we don't wake up in 23 and everything's a bit stop-start again, as we have had a couple of difficult years. So is there anything that you're seeing in the businesses that you're meeting which shows that level of innovation on how you gain that customer's attention?
Is it innovation? I think it's diversification is quite important at the moment, not being reliant upon one channel or not being reliant upon kind of one channel to sell your product or one channel to recruit your customer. But I don't necessarily think that's changed longer term from what businesses should have been doing anyway. Should you rely on one source of customer, or should you rely on one source of supply? No, I think businesses have been able to grow over time to a certain size by doing that, but by being able to kind of promote themselves via using technology, using social media, etc. So I don't think the general principles have necessarily kind of changed. It's just ensuring you can diversify. So with quite a few food businesses, we're seeing them go out to kind of festivals, for example, and talk to people, more kind of direct selling. But a lot of the food guys have been doing that for a while, but that seems to be working very well at the moment. As kind of Facebook and Google get more expensive. You see people doing very well on TikTok, but I think that's kind of hit or miss, really. If you can get something to go viral there, you can do very well. But no, I think it's all about the diversification of channels, and both from a kind of where you sell the products and where you recruit your customers from.
And clearly, you're a consumer facing fund looking to do new deals, even if the market is feeling more challenging than perhaps it has done. What is it that you guys really look for? And for people in the audience today, what are those maybe 3 top tips you can say that are really important as somebody may come, these people who are saying, right, actually liquidity is going to be really important for us for our medium term plans. We might want to think about raising some capital in the next 12 months. What are those 3 top tips that you might say to someone that they need to be ready for if they're going to talk to an investor, or they're going to be talking to their lenders as they go through the next 12 months thinking about liquidity?
Yeah, I think the first one is your proposition. I think I've touched on it previously, but it's being able to kind of demonstrate that you are better and different versus your competitors, and being really kind of clear on why a customer should buy you over someone else, and not just be a me too product. So being really clear there. I think secondly, being able to show that you have strong margins. So I think gross margin in particular, that for me is the strength of a brand. So it's the amount that someone's willing to pay over and above the amount that it costs you to make that product. And if you've got growing and strong gross margins, then you're going to be a brand in demand. And I think you asked for 3. I'll go for a strong team. So really having the people in place to drive that business forwards. And I know recruiting good people is a little tricky at the moment, because I think people are a little bit more nervous and kind of staying where they are. But if you've got that strong team in place, then an investor is going to be interested in you moving forward. And I think, as you mentioned, Laura, we need to invest, not just because I'm paid to, but we're a fund. So yeah, we look to make two to three investments a year, and there will be great opportunities. So I remember that in the last recession, following that, we invested in Lounges and Be At One, 2 restaurant businesses, and they were able to get fantastic sites at much cheaper rental deals. So opportunities kind of will come along on the high street or elsewhere.
Perfect. And so as we draw to a close, I thank you from me, but is there anything, Rory, that you would say as a final comment to close our session?
No, I think it's kind of crazy times, isn't it? 2019 seems so easy compared to now. Obviously, we had Brexit thrown at us, followed by COVID, followed by a war. So, but no, people have kind of got through it, haven't they? So there will be opportunities to grow businesses, and the best businesses will do very well.
Well, thank you, Rory. Thank you for your time this morning. And with that, I'm going to pass over to my colleague Cherry, who's going to take us through some of those areas that, again, might be keeping you awake on some of the risks that are exposing some of our clients, the businesses that we're talking to right now, and what you can do about them, how you can mitigate some of them. So with that, I'll pass to Cherry.
Thank you, Laura. So yeah, hi everyone. I didn't want to, I'm going to try not to continue the doom and gloom theme too much. And interestingly, listening to what Rory said, I actually think it's a really interesting lens to put on risk, to think about the opportunity side as well. You know, risk is both about protecting and creating value. And a lot of people think about risk and think about, oh, this is more red tape, and, you know, and are we really in this time when we need that? But actually, what I see can be real value in thinking a little bit more about your risk processes is how you're going to prioritize the things that are really, really important that you get right when we're going through, as we've said, you know, we're going into a serious cost of living crisis, things that really are going to impact you. So if we just flip on to the next slide, there's just a few areas I wanted to pick up on, really, again, thinking about what are we commonly seeing organizations focus on. So firstly, at that sort of holistic level, organizations really are thinking about that prioritization exercise, as I said. What are those fundamental risk areas where you've got finite resources? Where are you going to focus those efforts, just to make sure you are protected during this kind of batten down the hatches time, for want of a better description? And linked to that, then, those absolute key control activities that you need to make sure you continue to carry out, because you'll be at serious risk of your business not being able to operate if they're not happening. And also getting yourself into a position with some of them that, as some of those external factors ease, you are best placed as an organization to capitalize on that. So again, as Rory just said, you know, if you're in a good position, then you might be able to pick up cheap leases and other things as a result of what's happening externally. So just to pick up on a few of the areas, as I say, that we're seeing quite commonly organizations are focusing on. So no surprise, cyber has always been there, but we are in a period of heightened risk. I saw a statistic the other day, it's something like 265% increase in reported attacks. You know, hybrid working taught us that, and needs to think differently about how we address that risk, because all of a sudden lots of people working from home, and that brought along a different cyber risk. Just picking up again on what Rory just said about diversification of channels, absolutely see that on social media, but that also comes with a different level of cyber risk. And actually, are we thinking a little bit differently about that and how we manage it? And are there a few things that we do need to focus on just to make sure we're as protected as we can be? Secondly, fraud. Again, no surprise, but again, a statistic I read the other week was bank fraud hits, I think it was $1.8 billion, you know, and I think that was just in a 2-month period. So when was the last time you thought about those key controls and key risks around fraud within your organization? Just 1 or 2 tweaks around that can make sure that you are increasingly protected during this period of tough times where, you know, fraud opportunity is heightened. Next area, financial control, thinking about some of those fundamentals, things around revenue recognition, around working capital management, liquidity, how well are they controlled? As we talked before, really, really fundamental, again, during this tough time. Transformation, So you may sort of think a funny one to put on there, but there has been a lot of transformation happening within the sector, whether it's digital, financial, and actually one of the things we're seeing is that those programs are continuing to a certain extent, but actually focusing on how well they're managed. You know, it is an area of leakage in terms of cash. So let's make sure that we are focusing on, you know, the key milestones, managing the budgets well, making sure we're focusing on the value that we want to get from it. Next one, inventory management. So shrink, a common area where, again, organizations are really struggling. So again, do you understand that process end to end? Are there areas where it could be better managed, so that you can unlock some more of that, I guess, yeah, some more of the funding within that. People. So again, we talked about, I think that was the third point that Rory made, and we talked on our last webinar all about ESG, and just picking up on the S in the ESG, that's all around the social side, that's around the people side. How are you looking after your people, thinking about well-being, thinking about reward, thinking about culture? We all know that retention is incredibly important at the moment. Getting that balance right between short and long-term needs is going to be increasingly important. And finally, Matthew and Neil picked up on supply chain resilience, looking at it from an efficiency lens, looking at it from a contingency perspective. We've seen those challenges over the last 6 months, particularly driven by the war, and how can we protect ourselves more around that? So lots of food for thought there. Probably, you know, nothing that is news to you and things that are always on your mind. But I thought useful to kind of focus a little bit more on some of those areas where actually, if you can kind of just pick out those few key activities that you might want to focus on and prioritize, and actually you can protect yourselves and create value when things do ease off again in the future. And that's everything I wanted to cover, Laura.
Thanks, Jerry. No, that's really helpful. And so I'm now going to invite all of my colleagues and Rory back for just some general Q&A. So if anyone does have any questions, please do drop it into the Q&A box. But I'm going to start on the, I suppose, the theme that has resonated through all of the discussion that we've had this morning, which is around working capital, stock. You know, we know that a lot of people are carrying probably higher than they would like levels of stock at the moment. We're very much in our spring summer season, and everyone will be thinking about autumn winter. So given that it was clearly one of Cherry's risks, it's something that Sophie left us with food for thought. Sarah, what are your thoughts around working capital management in the short term, but also perhaps the medium term as we go forward from here?
So I guess, obviously, coming from, I'm a business restructuring partner, in case people didn't know. So helping businesses with liquidity issues, and working capital management is obviously key. I guess for retailers at the moment, the decision is, you know, do you discount to increase your volume and release therefore cash into the business, which helps with the inflationary issues that are coming up sorry, I had a little bleep there, I should have turned that off. So to deal with the increased costs, or do you hold tight and wait before you discount? Do you increase your prices to cushion the inflationary costs, but then you might have a lower volume of sales, and you need to, obviously, as Rory said, understand impact of all of the balance of what you do with your stock and your pricing, the balance on the impact on margin. So we would always say in business restructuring, having a set of forecasts which are integrated, that you can flex and build in different sensitivities, will give you an idea as to how will help you in managing your working capital. Working capital, you may have a far more requirement for cash being put into the business in the shorter term as the inflationary costs are high, but you may be able to work that through as inflation does come down. So it's really key to have the tool set, which is for us the integrated forecasts and that cash flow forecasting, and understand what's happening with your unwind of your balance sheet.
And Rory, what are you seeing in your clients? Of, you know, is stock an issue? Is it something that people are really thinking about? I know when you talk about premium, and certainly there'll be businesses that are listening in today where, you know, discounting historically, it's not the right thing to do, but you know, is it better to get into that liquid cash position, or are you seeing people just hold fire and ride the storm in some ways?
Yeah, it's certainly a balance, isn't it? So yeah, there are no doubt businesses that are sitting on more stock than they would like to, and subsequent less cash than they would like to. So I think it's being really kind of strategic in how you kind of liquidate that in a way. So what you don't want is a 50% blanket discount to your whole database, because it might work this year, but you probably won't have a strong brand next year. So you can't be too kind of short-termism. It's trying to kind of find avenues to kind of maybe work with partnerships, maybe work with certain kind of retailers that kind of take on your stock and sell it in store. Maybe only target those who have bought from you with a discount previously. That's another good way of kind of helping to kind of clear that stock. But blanket big level discounts, great today, not so great tomorrow. So I think it depends on your level of need and where you sit, but it has to be thought through strategically, certainly with the businesses we're working with.
And Neil, Matthew, sort of that bit where people have bought in stock. You talked about the duties, you talk about the taxes, but taking some of these business decisions to manage working capital, manage inventory. Again, you touched on some of the points, but anything else worth just flagging that people should think about as they're forming these both short-term, medium-term plans, so that they can manage the liquidity, but also manage the business, and if there are any upside opportunities from a tax perspective that softens the blow slightly.
So, I mean, I think a lot of businesses, when they're doing their forecasting, certainly in my experience, look at pre-tax cash flows. And when you start thinking about tax holistically, it can mount up to be a very big number. So combination of VAT, employment tax, international taxes, duties, as we talked about this morning. It's not just corporate tax. So getting a handle on what you're paying, where you're paying, and why you should be paying that tax is really important in your cash flow modelling. And I think the sort of precursor to that is having a clear overview. So touching on some of the points that Cherry made, making sure that you've got your taxes managed in an effective way. You know where the key risk areas are. You're doing things right the first time so that you can sort of prevent challenges from HMRC or other authorities if you're an international group. And you've got a sound filing position for what you're paying. So getting that right from the outset is really important. And then delving a little bit deeper, I think understanding the attributes you've got. So a lot of consumer businesses did struggle during that COVID period, so probably got some tax losses at a corporate level. So how can you maximize the benefit of those? Some of the businesses are thinking about investment opportunities, whether it's new stores, new infrastructure. So how can you maximize tax relief for those costs? And, you know, thinking about the disruptor brands, what are they doing? Is it innovative? You know, can you get R&D tax breaks either in this country or somewhere else to really help your cash flows and get some funds into the business? Matthew, I don't know if you want to comment specifically on duty in that aspect.
I mean, just a quick one from me, Neil. I think, you know, the bigger businesses that tend to hold a lot of stock in the UK or Europe, I mentioned earlier, you know, think about customs warehouse, and the reason, Laura, why that's really useful is it gives you that time to think. You can hold your stock within a customs warehouse and not pay the import duties on it. So if you have that time to think, then if you release it to the home market, you pay tax in the UK. If you want to push it into the EU, you won't pay any UK taxes, you'll just pay them on the EU side, which again, it's just about minimizing the costs within that supply chain. And if you've got a really big warehouse with an awful lot of textile goods and an awful lot of suspended customs duty, the guarantees to operate that warehouse can, will give you a massive cash flow advantage. Because if you're holding stock within that warehouse for a couple of months, you're not having to pay that duty immediately when the goods land or the import back. It can be a big cash flow incentive to operate a warehouse. So what I'd just say is, again, think about the optimization from a customs and import duties perspective, because it can make a real difference to cash flow and a real difference to bottom line costs.
Thanks, guys. I guess another point that Rory flagged, but it has been repeated, that strength, depth of the management team, the leaders of the business. And we know this sector resilience has been something we've talked about so often, that we've had to be resilient. As Rory put it, Brexit, COVID, the war, and now we face just some increasing challenges of not only inflation in the business, but inflation with our end consumers that continue to be quite unpredictable, and it's difficult to say where we're going to head in the short term. But that strength and depth of the team, that resilience of the team, Cherry, going back to you and the risks that you see, how do you see the best teams that you work with really attacking that table of risks that you put in front of us this morning?
I think, again, it's, to be honest, it's scrapping the word risk for starters, and just kind of thinking about just what are the fundamentals to how we, what are the fundamental things that we need to do to achieve our short and long-term objectives, and making sure that everyone's clear on that everyone understands their part in it, and making any small changes. Again, as I said before, we are in a position where we've finite resources. That's not just people, that's money, that's stock, that's whatever that is. So actually just making sure we're putting them into the place where we're going to get the most bang for our buck. So yeah, it's a really difficult one, and there isn't a magic approach for everyone. But I think if you can be really clear on sort of what are the top 3 to 5 things that you just need to focus on for the next 12 months, then you're going to, again, to my point about risks, it's not just about protecting you, it's also about positioning you from an opportunity perspective when we come out the other side of it.
And Rory, any thoughts from you on what makes those management teams, what good looks like for you guys?
Oh, how long have I got?
About a minute. So
yeah, we're obviously working with founders with great ideas. So it's quite often kind of complementing them with people who have been there and done it before, who kind of So for us, it's a real balance within a team, that those who are kind of shooting for the lights, and those who are looking at the kind of checks and balances as well. But generally, people who've been there and done it before in this current environment would be a huge asset.
And so my final question to the panel this morning, we, as it says there, we have our next seminar at the end of September. The reason that we've chosen that date is that we're going to look towards the golden quarter, as it's often known, as we go into that final Q4 trading. Now, a lot of decisions will have already been made, or people will be making them now, as to how they're going to think about that golden quarter. So I'm really interested to put my colleagues and Rory on the spot on what they think people are going to see around Black Friday this year, because it's definitely something that's being discussed when I'm talking to some of my clients and the businesses that I'm connected to. We're about to see Amazon do their July Prime today, tomorrow, so it'd be really good to see how far and how deep they're going to discount through the summer Prime Day. But what do people think the temperature check's going to be on Black Friday and the Black Friday week as it's become here in the UK? Rory, let's start with you. put you on the spot.
Yeah, no, I think well, I think maybe retailers and brands will be more sensible on their buy-in. So I don't think they'll be kind of thinking it's going to be a bumper Christmas and a bumper Black Friday. So I think they'll buy sensibly, which will mean that they'll be able to maybe discount sensibly and just be a lot more strategic in how they think about making money during Black Friday and not just offering 50% site-wide. I think that's really, really important, because I think consumers will be looking for deals. There's no doubt about that. So I think it's looking to be kind of strategic in that you can make money at that time, as well as kind of discount and grow the top line.
Sarah, any thoughts?
Yes, well, I guess it depends on how they've traded over this quarter coming into the golden quarter. And exactly what Rory says in terms of maintaining business and maintaining the brand and the impact that heavy discounting will have. But I think there will be a number of retailers that will have issues going into that golden quarter, and may use that Black Friday as an opportunity to liquidate and generate cash.
Neil, anything to add?
I think Black Friday will be smaller. I think discounting will be much more targeted. I think certainly retailers have learned with all the challenges over the last couple of years that blanket discounts are not the answer, because they have a long-term adverse impact. But I think Christmas and the golden quarter will be solid this year.
Matthew, Cherry, any further thoughts from you guys?
Not much from me. I'm always very optimistic towards Christmas, so I'd like to see the interplay between Black Friday and, as Neil has said, how Christmas plays out. But I think it would be, after a challenging year, it's always nice to have a good Christmas. So I think spending will be relatively normal, I would imagine.
I guess the only 2 points I'd add is that we talked about sort of supply chain resilience, and actually just interesting to kind of see how that does factor into decision making, and so organizations are not left with hundreds of things they can't sell because they've not planned properly. And secondly, for me, actually picking up on what was talked before about diversification of sales channels, and I'd be really interested to see kind of what perhaps we get this year when we get into the golden quarter, and whether people do harness that as an opportunity a little bit more.
Great. And I think your point, Rory, around that discounting to losses, we have been there. A number of clients have fallen foul of the Black Friday challenge, where cost of customer acquisition has just outweighed any kind of profitability when you put the discounts. So I think it probably comes from all of us with a bit of a word of caution, but I think generally that unpredictability is going to continue. So having those plans and having that focus is everything that we're seeing of the people that are succeeding. So I'd like to take the opportunity to thank all of the people who have joined us today, all of my panelists, and I very much look forward to seeing everyone back with us at the end of September, with hopefully a summer that has continued to shine, which we know in this sector does drive the consumer to spend a little bit more. So again, a high street sales tracker that maybe is less grey, let's call it, as perhaps it's been this quarter. So I hope everyone has a good day. Thank you for your time, and we look forward to seeing you next time. Thanks all.